Hello, fellow Rebel Capitals. Hope you're well. I am back with my good buddy Chris Martenson. And my friend, we have a lot to talk about. So many people are thinking about AI, but they might be thinking about it the wrong way.
Mm-hmm.
You want to go into your presentation from Limitless? It totally blew me away, by the way.
Oh, thanks. Yeah, you know me. I'm an inveterate sort of a resource guy, and I like to just see where the numbers take me. AI has been absolutely explosively eating into obviously energy demand. We know that, right? Some of these data centers, George, they say 2 to 5 gigawatts. I mean, just to put that into perspective, Denver is a 1 gigawatt city. So
Yeah, but I don't
like,
know that a lot of people know that, Chris. I think you know that because you pay attention to energy and how that is the economy. But I
yeah,
don't know that the average Joe and Jane knows anything more than, oh, hey, this chat GPT thing is really cool. I can kind of ask it a question and it
yeah.
gives me a pretty good answer.
Yeah. All right. So I mean, what is AI? It's a bunch of computer chips. If you've ever had a desktop computer or something, you know it's got all those cooling fans, and you
Mm,
can feel it just radiating all this heat, right? And that's if it's just got, one single GPU chip in there. These H100, H200 NVIDIA chipsets that's, taken over the world. These things, George, it's like having each one of those would be like having a couple hundred computers all at once on your desk, right? So these things are energy pigs. They just take electricity, they turn it into heat and cute pictures of cats on skates. That's the whole thing.
right. But it's not just energy, it's also water. And I had thought through the energy component to a certain extent prior to watching your presentation. But then you brought up water, and that is something I had never considered. So I think what's important right now is we go into how the energy use will most likely, or the energy needs might not be the use, because I think this could be a constraint on AI, but how the energy needs will go exponential, and how the resource needs, but water for cooling, will go exponential, and then maybe walk people through how much capacity we have to increase the access to the resources we need to make AI happen. And then, what does that do to the rest of society? And what does that do to prices? What does that do to the economy?
Oh, those are all such great questions. And I'm glad we're talking about it because I don't think it's getting quite the overview that it needs at the
Agreed.
higher levels. And so the basics is this. We mentioned, okay, we have these chips. They're burning a lot of electricity. I mean, a lot. So we have one question. Where does the electricity come from? You have to generate it from something. And no, solar and wind is not the answer for all sorts of reasons, right? And we can get into that if it's necessary. And then two, you have to cool all those chips back down again. So they have a thing where they can cool them down with air and air cooling units, like an AC unit. Not very efficient. For the really high end chips, they have to be liquid cooled or water cooled. And of
Mm.
course, this takes not, you can't use salt water. It's got to be it's pure water. So in Texas, in 2024, I think they consumed something like 243 million gallons of water. This year, they're on track in AI super centers. They're going to consume 49 billion gallons of water. Now, Texas is a good place. They have a lot of stranded electricity in this form of natural gas they flare off. They've got a pretty robust grid. So from a power standpoint, Texas makes sense. But from a water standpoint, Texas obviously is a part state and struggling. So we're already starting to see these huge conflicts between what does AI need and what do the people need. And I'm not sure we're seeing that getting balanced, but I'm sure you caught this. In the big, beautiful bill, I think it got stripped out, but they tried sneaking in 3 paragraphs that said, oh, by the way, states can't do anything to limit or constrain the growth of AI in any way, shape, or form, which would have
Mm.
included these things we're talking about, pulling from the grid and consuming water.
I did not know that. And so
Yeah, it got
basically,
stripped out,
just so
thankfully.
the audience is following along there, what they had in the big beautiful bill was these paragraphs that basically gave the priority to AI over humans in terms
Yes.
of energy. And if those people are, or for those who are new to the channel, energy is the core of everything we do. Energy is the economy. Energy is humanity. I like to look at a chart of energy usage and global GDP and global population, and they are tied at the hip. I mean, there's
Mhm.
not like a 70% correlation. There's like a 100% correlation. So if we want humanity to flourish, if we want our standard of living to go up, we have to have more energy. And if the energy we have access to goes down, then by definition, the standard of living will go down and the population.
Correct. And it's to get into the nuance of it, which is really important. Thanks for bringing this up, George, is well, it also has to be stable and it has to be cheap, right? If you violate either of those, so Germany put in a lot of wind and solar, which made it expensive to start, but also unstable. That's no good. Even if we said, oh, well, we found a way to harness wind and solar with, $1 trillion of battery packs. Well, now we no longer have cheap. You really need the cornerstone of prosperity, which is why I care about it. I think you do too. Same reason is, yeah, I want to live in a prosperous country, which means I need access to cheap, stable energy. And that's the part that we were just on the wrong path with all the green energy stuff. I mean, really bad. We'll see if we can get there in time because, George, the problem now is it's we have a lot of regulatory burdens in this country that say China doesn't have. I don't know if you know this, but they are busy scheming and building a power plant that's going to be 3 times larger than the Three Gorges Dam, which is already the largest hydro facility in the world. They are plowing ahead with both conventional nuclear facilities, fourth generation thorium plants, are trying them all. And they've very astutely said, China said, hey, we only want 12% of our grid max ever to be these, wind and solar alternatives because they're unstable. We think we can manage 12%. And that's a pretty reasonable energy mix. In this country, Trump passed an EO recently, an executive order that said, I want to see small modular nuclear reactor critical by July of 2026. Very ambitious. But that's an executive order. All the ways that's going to get tripped up in the regulatory and the courts. And, if the midterms don't go the right way, you can't just sort of say that and have it happen. There's a lot also that has to happen because of how we construct our country and how we operate it. We're not ready for the power demands of AI, and AI already figured that out. So you saw Microsoft make a deal to reopen 3 Mile Island's reactors because they needed that power. You saw Microsoft put in another huge facility, Meta, down in Alabama. They constructed a data center right now. George, it has a 2.2 gigawatt combined cycle natural gas plant, and it's just hooked up to a natural gas field. 2.2 gigawatts. You could run, again, 2 Denvers off of that just for this one data center. And so when you start adding all of this up, you go, A, can the grid handle this? B, where's all that natural gas going to come from? Because that is natural gas is the way you fill in the blank when you say, before we get all these nukes built, if we ever do, how do we fill in the gap? Well, we're not going to build coal plants, obviously. Wind and solar aren't the deal. Batteries are batteries. What do you charge them with? You still need an energy source. So natural gas is the only thing I can find that sort of immediately can fit the bill here. And that's what they've been going with. But then you look at the natural gas side of the store and you go, okay, do we have enough, for huge LNG exports that are happening right now? The fact that for whatever reason, natural gas production's been flat for a little over 16 months now. And there's all these new demands coming on board, which include AI plus exports in the form of LNG plus, plus, plus. So you add it all up, and I can't find anybody, George, that's really like adding this up properly at the government level. I don't know what they're doing.
When you're saying that, what's going through my mind, Chris, is that chart that you showed, and maybe I can have the editor throw it up in your presentation. And I believe it was China's electricity output versus the United States going back to, what was it, 2005? And they've increased their energy output to 10,000. I forgot what the unit of measurement was, but during that time frame, the United States is basically flat. You know the chart that I'm referring to, and can you explain that a little further? There you go. Perfect.
It's this one.
Perfect.
Yeah.
Yes.
So what we're looking at here is 2 lines for anybody who's just listening. We have 2 lines in here. One's the United States, one's China. And the y-axis is in thousands of terawatt hours. And the United States, starting about 2000, was at about 4,000 terawatt hours. And today it's just a little north of that. So we've had maybe 10% growth in our total energy output between 2000 and 2025. So 25 years, we've bumped it up a few percent. China went from about maybe 1,800 terawatt hours, crossed the United States, matched our energy output in 2010 at 4,000.
Mhm.
By 2020 was at 8,000 and is currently at 10,000 terawatt hours. So they have basically 150% more electricity production than we do. So
Look at the trend.
yeah, and it's not slowing down. They are slapping that, and 2 coal-fired plants per week are going in. Hydro, nuclear, they're throwing everything at this they possibly can because they get it. They understand
Yeah,
that
so
this is important.
so the next thought that I had was, okay, so China's obviously doing what they need to do to have enough energy capacity for both humans and AI in order to leverage the power of AI without decreasing the standard of living or the population, let's say. But in the
Well,
United States, we're not doing that. And thankfully, this was taken out of the big, beautiful bill. But if we have something like that in the future, I can see the United States government or the central planners arguing that it's a national security risk to
correct.
not prioritize AI. And therefore, because we have to compete with China or because it's a national security risk, you need to go without energy. So we need to have these rolling brownouts, let's say, or blackouts, or you need to, ration something that we maybe saw during like World War II, because that's you doing your patriotic duty, because all the energy that would be going to humans in the United States needs to go to AI, and we don't have that capacity. That's kind of my concern as to how this plays out.
This is, yes, I agree with that prediction. Someday we'll wake up, George, we're going to read the headline, Cincinnati goes through 4-hour rolling brownouts because, AI, the data center needed it instead. It is a national security issue. They've said as much. We know that the, government's come out. I think it was Bergram. I don't know why the Interior Secretary told us this, but he did. And he said, look, this is existential. Whoever gets to AGI first or whatever their benchmark is wins. And we don't know that there's any catching up. So this is a race we can't lose. So it will be framed as a national security issue. And that's why I think they tried to sneak that language into the big, beautiful bill that said states can't do anything to limit, constrain, regulate, or inhibit in any way, shape, or form data models or data center construction.
So then I think now let's take it to the next step, because I'm sure a lot of people are saying, okay, well, Trump or whomever comes after Trump, they just need to do everything that they can to increase the energy output for the United States so we're never put into this predicament. But what you went over in your presentation, and what I'd love for you to go over now, is how even if we want to flip that switch, no pun intended, we might not be able to, because another chart that I don't know if you have handy there is
I do.
we see the energy output of energy increase in the United States tremendously since I believe it was 2010. But you show that that was almost exclusively a result of fracking, and how that has hit its peak and now is rolling over. So let's talk about the supply side of the equation, and to answer the question that even if we did the quote unquote right things from a top down approach, can we even get there?
There's a couple things that come out, and one is called the short-term energy outlook at the EIA. And I think they do a good job modeling, but George, making predictions about the future is tricky, right? And they do a good job. And last year's long-term, their annual energy outlook was kind of different from this one, but they're starting to dial in. They understand the limits of shale. This is in the vein of what we're talking about. This is probably the most astonishing chart here, where they're showing total energy production, again, from the EIA. This is part of their annual energy outlook. So we're looking at
Okay.
crude oil and least condensate, natural gas plant liquids, dry natural gas, coal, nuclear, hydro, biomass, that's wood, other renewables, everything. And the total is this top dotted line up here. Does that look like it's growing exponentially? Does that look anything like China's power curve? Like they're saying between here and 2050, I'm going to call that flat. They're adding everything up, and they're saying we don't really know where we're going to get a whole lot extra out. And the only thing that I could possibly imagine we could do over the long haul would be to get nuclear in as fast as possible. So that's it. So
What's the best case scenario bringing enough online to meet the demands of humans and AI within the United States?
Well, if we were going to be real smart about this and I could wave a magic policy wand, we wouldn't be exporting LNG to Europe.
Right.
We would keep that for ourselves. That's our prosperity. The fact that we take this perfectly usable molecule, compress it into a liquid, which loses energy, takes energy to turn it into a liquid so we can ship it. And then we ship it over there and then we get money back. I'd rather have
Yeah.
that energy here in this country doing good stuff, building new bridges and, heating apartments and doing important things like that. So we're going to see a conflict in the next, I would bet, 5 years or so between exports and domestic use.
Okay.
Hate to tell our European friends this, but to the extent they were counting on us to deliver that stuff, they need to look at this data and think carefully. Because if pinch comes to shove, you know what it is, George. Every nation has to eventually take care of its own needs first. You hope, right? Best case, we find out that we can build small modular nuclear reactors in a modular fashion, meaning you crank them out like Volkswagens in a robotic assembly line, right? You don't have special hand-built Bugatti Westinghouse things on this site. They're all the same.
Yep.
They fit into these 40-foot storage containers and you start cranking these things out en masse, right? Then at a minimum, we should be doing that because nuclear is the best way, I think, at this stage to create electricity that's stable and cheap.
How long would
Past
it
that,
take for us to get that online, Chris, to the point where it would satisfy the needs?
I don't really know because it is so. The other problem we have right now is two things really. It's labor and material science and the materials themselves. So if there are specialized components, we do not have, for instance, George, right now, the uranium supply chain within our own country because we shut down all the uranium mines many years ago. So that has to come from somewhere. Canada has some pretty good deposits. They're not exactly all that happy with us at present, but maybe we could get past that. But first, you'd have to figure out where we're going to get all this uranium from, and then second, do you have the manpower and the skill sets necessary? Because you still need highly qualified people, grid
Yeah.
scale operators, installers, people who are maintaining the plant specialists, all that. Don't know. I don't know how much that would take to scale up, but I'm hearing scary things out of, say, if we wanted to suddenly scale up something we do know how to do, which is drill offshore. Well, we just gray haired out a whole entire crop of people and they're gone. So I don't know how fast it would take years, I think, to really ramp that back up. So there's questions that need to be resolved there.
So, say realistically, we've got 10 years before we can roll out a total nuclear solution. And that's just for the electricity. Obviously,
Mhm.
that doesn't, I mean, you point out in your presentation that just because we have electricity doesn't mean that all of our energy needs are satisfied or all of our fossil fuel needs are satisfied. Maybe that's a better way of putting it,
Right.
because the fossil fuel and oil goes into so many components of what we use on a daily basis. So you've got that, the more we need that for goods and services, even if you're able to transition into an electric, let's say, transport economy or enough electric capacity for humans and AI. But do we have, let's just assume for a moment that we didn't export any nat gas at all, and we started keeping it all here in a strategic reserve or something like that. Would we have enough to bridge the gap for the next 10 years, understanding the exponential growth of AI and how that will likely lead to the exponential growth of these data centers that consume more energy than the state of Colorado or whatever it was?
Well, yes, the answer is yes to start. If we have about 700 trillion cubic feet of natural gas reserves that are known
Okay.
about, let's imagine for reasons we can get half of that out. That's still going to give us a couple decades at current consumption. And that would be fantastic. And
That's
we
at current
should be thinking
consumption.
about that way.
That's the problem. That's at current consumption. And
Right.
yeah, so go over the increase in consumption. And just I think a real world example that everyone can get their head around is the increase in electricity prices over the last, let's just say, 3 years. And when you line that up with the usage of AI, there's a strong correlation there.
Mhm.
So it's not just quote unquote money printing let's say, that has increased your electricity price, it likely in a lot of areas is Sam Altman or Chat
Yes.
GPT. You know?
Yeah.
My point there is that without AI, even without AI, if we want our standard of living to increase, and assuming we have the population increase, our energy needs are going to go up over the next 10 years.
Mhm.
But if you throw AI onto that, now all of a sudden, our energy needs could be double within 3-5 years. So do we have that type of nat gas supply in the United States that we could access?
The answer with an asterisk, because these things always come with an asterisk, is not at current prices. So this is
Right.
one of the things I wanted to alert people to, is that at current prices, I'm making a number up, but roughly we're about $3 right now per
Okay.
therm in natural gas. There's 18 drilling rigs currently operating in the Marcellus because that's about how incentivized they are. If natural gas went to 12, all of a sudden you'd see a lot more rigs and a lot more would come out of the ground. But of course, now you're using it faster. So the resource that could have lasted this long is now going to last this long. So the real thing we should be looking at, every business has a strategy, a good business, right? And a strategy could be fancy, but it's where are we going? How are we going to get there? Right? What's our vision? What are our resources? You're always resource constrained. It's easy to think of cool things to do, right? So the question is not if, but when that resource runs out. And even if it's in 100 years, you should have a plan that says, okay, well, in 100 years, though, we're going to have all these nukes and we're going to have this thing and it's going to look like this. And here's how we're going to maintain it. I can't find that plan. China has one. I've read it. It's pretty comprehensive. I might quibble with it, but they have one. We don't have one, right? We got Chris Wright, the energy secretary, we thought he was going to be the oil guy. He didn't really turn out to be that. He's saying, oh yeah, oil makes sense at $50 a barrel, we think. And it doesn't. And he should know that. And so
can you explain makes sense, Chris? Because I want to make sure that doesn't go over people's heads.
Which part? The making oil makes sense at $50?
Yeah, what does that mean? I mean, I know that means that the cost of production is higher than that, but can you explain that for the viewer?
Yeah, I mean, oil I love the business because you put money into making a hole in the ground and then money comes back out. So it's actually fairly simple and there's not that many fingers in the pie. So it's pretty easy to calculate. You have a royalty holder, they get some percentage of whatever comes out of the ground. You have your working interest partners, they have some percent of the deal, right? Some of it may have been debt financed, it's owned by the company. But anyway, money goes in. And generally speaking, right now, George, it takes, in the Permian, you're going to put $10 to $13 million into that hole in the ground. And then oil's got to come back out and give you money back. So at current prices, there's this fiction going on out there that says, oh, the break even in the Permian is 60 to 70, implying that if you got $60 to $70 back, you would break even, you'd get your money back.
Right.
That's not that exciting because it's kind of a high risk business. So, you have price volatility, you have downhole risk. Sometimes you drill dry ones. It's a risky business. You want to have a pretty decent return to incentivize that. So break even's not interesting to me. The second thing is there's $200 billion of debt across the shale space right now. And that has to be paid back at some point, right? I hope, right? Or we're just going to write that off, I guess. So when you look at all of that, including the debt servicing costs that sit on that, I think we have to have oil production numbers that are going to be incentivized somewhere between $80 and $90 a barrel. We'll get a little more out of the ground. But regardless of the actual price at all, there's something new on the table now, George, which is the geology. So high prices are exciting. They stimulate a lot of behavior. But let me give you a quick story, which I got from Adam Rosenschwag of Gehring and Rosenschwag. They said, look, we studied this before. The United States hit a peak of production in 1970. Oil was $3.17 a barrel in current terms back then. And then we had this OPEC crisis, 1973. Our production sort of bumping along, but nobody really knows it was a peak yet until much later. But they said, oh, okay, we're going to need a lot more coming out of the ground. And Nixon had a national petroleum, program. It's like drill, baby, drill, right, of the time. And so they relaxed regulations. They got more drilling going. And oil went, George, after the OPEC crisis to $33 a barrel. Can you imagine that? A tenfold increase, like oil went today to 600 a barrel. You're like,
right,
that's a lot of drilling is going to happen all of a sudden. It's going to be wildcat times. So that's what happened. We went from 995 rigs to about 4,500 rigs in a space of 3 years. They were just slapping holes everywhere you could. And you know what happened?
What's
We
your
got
price?
less oil out of the ground that year, and the year after that, and the year after that. And the
Less oil?
reason, less. And the reason was, it's because it gets a little nuanced, but the most important metric in oil is your drilling productivity. So that's per foot drilled.
Mm-hmm.
So if you're in high quality rock, you might get, let's say you got a barrel for every foot you drilled,
Right.
in return. Great. But all of a sudden you get to lesser quality rock. It's not quite as good a play, or you're putting an infill, you're drilling around the sides of something you've already taken the sweet spots out of. Now, if you're getting a half a barrel per foot, the faster you drill, this is the depletion paradox, the more ground you actually lose in this story. It's a
Yeah.
really weird thing. It's all been modeled out. The guys at Gehring and Rosenkrantz have a great thing on that. Their third quarter 24 report, beautiful, titled The Depletion Paradox. Well worth reading. At any rate, we're at a place now where the geology of the shale spaces is limited. The Bakken up in North Dakota has already rolled over. The Eagleford has already rolled over. Actually, everyone I've looked at has rolled over except the Permian. And the Permian is actually down to just 2 counties that are still growing their production, Lee and Eddy counties in New Mexico. So those are still growing, but the whole story of Saudi America is literally down to 2 counties in New Mexico right now. And guess what? They'll drill those out eventually. This was the shocking chart, the one that I really wanted to get people to look at. This
Yeah.
is from the U.S. Energy Information Administration. This is their annual Energy Outlook 2025. It came out in April of this year. And let me mark this up. Look what they show here. Total production of crude oil and least condensate last year in the 2024, they had this line going straight all the way to here.
Huh.
Now they had to dial it all the way back down. And this is based on new information that's come in and a new modeling of the fields. And this is, George, this has to be the biggest information nobody knows about. This is a
I
big deal.
completely agree.
Now, look at the scale here. 28 goes to 29 quads. They measure it in quads, not barrels of oil. Don't ask me why. This is quadrillions of BTUs.
Chris,
And
I'm having a hard time seeing the year. What's the year that
this
you
is
got highlighted?
2024 here, and this is from 2025 to about 2030. That's what they
Okay,
have
got it.
here.
Got it.
Yeah.
Got it.
And again, it doesn't go, this doesn't say it goes away, but the world where your energy supplies are increasing is a world where things are easier. You can make mistakes. It's a world where you can do a lot of things. In a world where oil or your prime energy is decreasing, totally different world. It's just
Yeah.
much harder. Like a company that's spitting out surplus cash can make a lot of mistakes. A company that's bleeding slightly has to be real keen about how it operates. So
Yeah. Can you pull that chart back up really quick,
sure
Chris?
thing.
Because what I want to highlight to people is, assuming that this is correct, and it seems like their projections are getting more pessimistic by the year, but assuming
Correct.
this projection is correct, in order just to maintain the standard of living in the United States with no AI, we would need something to fill that gap. You see how the
Yep.
dotted line is going down? We would need something to fill that gap to where it's level. And that would assume that the population doesn't grow. That would assume that there's no excess or extra demand from AI. So
Mhm.
where does that come from? I don't know. Maybe it comes from the small modular reactors that Chris is talking about. Maybe that comes from nat gas. Maybe that comes from wind and solar. I don't know. But even if it flatlines, that just means that the standard of living stays the same, assuming the population doesn't grow and we don't
Yes.
have extra demand from AI. Now, let's go ahead and assume for a moment that the population grows. Now we would need energy to not only fill the gap, but to make that line, that dotted line, start going up. So assuming that this was overall energy, right? We would need something for it to go up, and then throw AI into the mix. We would need this dotted line to go exponential. We would need it to go almost straight up, assuming that the government is going to not come in or not be put into a position where they demand that you use less energy for the sake of being a patriot and for the sake of prioritizing AI and all the robots that we have running around or whatever it is. Because if we don't, if we don't lower the priority on human beings, if we don't prioritize the artificial intelligence, then China, has an advantage because they've basically prepared for this from the standpoint of energy supply.
If the story of AI is as powerful as we think it is, and it could be, China's already won the race.
Yeah, right.
Because they have slightly less efficient chips. They don't care. They can throw twice as much energy at it as we can. And also, China, if they have to sacrifice a few valleys or a couple villages, doesn't matter. Like they will do that as well. But they're already so far ahead of this race that I don't know how we catch up. We would have to get really serious about it. And, that's why I was a little disappointed. I wanted our energy secretary to be telling this story because it's really important. I want my country to not lose. I want us to be prosperous. We can't afford to fumble this ball at this point in time.
Yeah, another way to frame it, Chris, is if you're all about MAGA, Make America Great Again, which kind of the core of that philosophy or ideology is bringing jobs and manufacturing back to the United States. Well, what does that do to energy needs? That people never think that one through. That if we want to bring all this manufacturing back to the United States, and if we want to have all these high value jobs, these added value jobs, then that not only requires a ton of energy, but it requires a ton of resources as well, which probably takes us into the next topic of discussion, which is the grid. I mean, we've been talking about, sure, we have what do we need to do to increase the energy supply to make sure we're not having to take it away from the standard of living of human beings? Even if we can access the energy, how do we deliver it?
This is going to be a really big deal. So the correct answer, I think, would be, again, small modular nuclear reactors. I would have one in my backyard if we could, solve the security issue. I wouldn't worry about it from a technology or melting down standpoint. The new ones don't do that, but you wouldn't want somebody to attack it or anything like that. But solving that, so we would have a distributed grid, right? We wouldn't be dependent on like one big powerhouse and trying to thread that everywhere. But still, we're going to need more transmission lines. By the way, quick story time again. I was out on this awesome. We did a Yellowstone backcountry fly fishing trip on horses. It was like being in the movie 1883, canvas tents, cutthroat trousers. It was lovely. So a couple of the guys there were from a little town called Ellijay, Georgia. And we were talking energy issues. And they said, oh, we had this Aldi store. They just built an Aldi. It's been sitting there completed 18 months. And it's not open. Like, why not? Because they couldn't get this 3-phase transformer. There were just none available. Zero. And we don't make them in the United States anymore. Well, where do we make them? They're made in Germany. They're made in China. And for whatever reason, they couldn't get their hands on one. So that just goes to show that even if we wanted to build our grid out, we may have to get as basic as saying, well, then we're going to have to build factories to make transformers again. Where are all the lines and the pylons and the linemen? I mean, there's a lot that goes into this that I think has been neglected for quite a while. And I'm not sure if even if we wanted to, George, that wouldn't be kind of a bumpy start even if we threw everything we had at it.
Yeah, I don't know how, if you get the government involved there, basically what you're doing is like a work program like we had in the 1930s, or a government jobs program. And that's going to distort the economy. It's going to misallocate resources. That's going to be wildly inefficient. I'm just trying to think of what the solution is. I mean, obviously, starting from first principles, we have to dig a lot more holes in the ground. Like that's what we have to start with, whether that's to access energy or to access the resources that we need to build out the grid. We got to start by digging a lot more holes. Now, who digs those holes? How do you structure that incentive? And even if we do dig enough holes, do we have the stuff underneath the ground in order to get the job done? Or are we going to be, or regardless of how well we do, are we going to be dependent on other countries? I mean, the first thing that comes to my mind is copper, right? Because Trump, I don't know where he is with that because it changes every day, but he had a tariff on copper. And a lot of the hedge fund managers that I know were saying this is the dumbest thing I've ever heard of, because how on earth are you going to bring copper jobs back to the United States? It's not like it's not like the supplier can just choose that. Well, I've got this huge copper mine in Chile, but I'm just going to bring it over to Wyoming. It doesn't quite work that way. So I know copper is a biggie. Have you looked into that to see how much we have in the United States, and is it enough without relying on foreign entities for this grid build out that we inevitably need?
The answer is no, we do not. So we had a couple of real world class mines, the Bingham Canyon mine and Anaconda. We had some good ones. They're played out. And just like all things, George, you know, we're human. So we walk around, you take the easy stuff, the veins right on the surface, there's nuggets lying around. And then you're going deeper and deeper and deeper. And for smaller and smaller finds. So the answer is no. The whole world is desperately short on copper. Goldman Sachs last year did an analysis and said, well, given all the permitting issues and how expensive it is, and like they have some more copper deposits in Peru, but they don't have the water to prosecute them. It's a big deal. You need a lot of water in this process. Issues. They said, well, we would need copper prices right now to justify opening the next layer of mines, which are a little bit more dilute, deeper, distant, tricky spots, right? We did the easy ones. They said copper would have to be around $35,000 a ton. At that time, it was trading for $9,000 a ton. What's it up to now? 12, 13, right? So we're nowhere near the price level needed to incentivize the next wave of production.
Right.
And the second thing is, you know, it's somewhat related, but I think it's instructive. I was talking with this guy, and he owned a company, and they put up the man camps that oil workers would sit in.
Oh, in like North Dakota?
Yeah, but I asked him a question specifically because people were saying, oh, there's all this, Chris, you don't understand. There's all this oil up in the ANWR, the Alaska National Wildlife Refuge, and Trump will open that up. And so I asked this guy, like, do you think that's realistic? And he just shook his head. I was like, well, why? There's oil up there. He's like, oh, yeah, there's oil up there. He said, here's the problem. There's nothing there. So you have to bring everything with you. And the only way you can bring it with you is by road because it's very heavy stuff. So your choices are to build an ice road, or you have to go all the way the long way around the coast where they actually have enough solid gravel you could build a road. He said the problem is that I'm not going to be able to build them. He said a man camp for 400 guys, 10, 12 million bucks, right? Because it's got ping pong tables, restrooms, you know. He said for me to build that camp, I'll do it, but I need a 5-year commitment. So I'm getting my money back in 5 years. The oil companies are not going to make a 5-year commitment because in 4 years, we might get a whole new president who says no to that. So the problem is nobody knows how to plan in this era of uncertainty. And so Trump jacking up a tariff and removing it the next day is contributing. The mining space is very capital intensive and it's very slow. And you can put in a lot of money into it and the next president can, you know, just pull the rug out. So that's all contributing to the answer is no, we don't have enough copper. And I don't see how we're going to get any without some stability in there.
Is there a possibility for prices to go up in the short term and that bring in a new technology that could potentially solve the problem? And just understanding that that new technology would not only have to solve an energy problem, but it would have to solve a resource problem, a lithium problem, a copper problem, a nickel problem. So we would have to have multiple solutions. Is it possible that those higher prices create those solutions to bring on the type of supply we need?
Yeah, it's a great question, and it gets a little philosophical. So let's take the two big models out there. China kind of does it by diktat. Now, I had a chance, George, to work with some fairly high-level people from China a while back. And it was like I was talking to myself because they were all scientists and, you know, PhD trained or whatever. They understood the resource issue. I have to fight in this country. People go, oh, no, it's not really a thing. But they understood it. And they understood that they needed to have access to resources. And that's what the whole Belt and Road Initiative is about.
Right,
but
right.
they make the decision sort of at the executive level. And they go, yeah, we're going to put in hydro. You're going to move those villagers out of the way. And we're going to go after nuclear. So they do it sort of from a command standpoint. We still operate from a market standpoint. And the only thing that can make the market respond is higher prices.
Mm-hmm.
Right now, the prices are not constructive to put in any of the stuff we're talking about right now. So,
you know what, when you said that, you know, it's funny, Chris, as you know, I live in Colombia and the Chinese have given Colombia quite a bit of, let's say, fiat currency.
yeah.
And so it's just really a wild kind of thought experiment, or I don't know if you want to call it that, but realization that we are doing the opposite in the United States. We are taking our energy and we are trading it for fiat currency. And the Chinese, who have way more energy than we do because they've kind of planned for this, are taking their fiat currency and trading it for energy.
That's what I would do too.
They're doing the exact opposite. We're trading energy for fiat currency. They're trading fiat currency for energy.
That's a great way to look at it. And it's exactly right. I mean, honestly, I mean, people like Warren Buffett said this 3, 4 decades ago, that the smart thing to do would be to not drill any of your oil for as long as you have the reserve currency and just buy everybody else's. And then when they run out, start using yours, right? That put you at a huge strategic advantage.
That's actually, yeah, that's actually pretty smart, especially when there's almost limitless demand for treasuries. I mean, I don't want to go way off topic here, but the bottom line is the 10-year treasury has moved off of growth and inflation expectations for the last, as far as I can tell, going back to 1950. It's always about growth and inflation expectations. It's never about supply. Unfortunately, I wish it was, because then it would actually constrain the government spending that's so destructive to the economy. But assuming that moving forward, it continues to trade off of growth and inflation expectations and not supply expectations, that would be just issue more debt to buy more. I'd much rather have them issue debt to buy energy versus issue debt to spend on another war or
Right.
On the welfare warfare state.
Yeah, that would be smart too. Or even if we had equal weighting, that would be amazing. Hey, I just have to ask you though, do you ever squint at how we have like one thing that drives me nuts to go a little into a cul-de-sac here, but the 10-year Treasury auction since 2018 has had a 2.41 bid to cover plus or minus like 0.02. Like it just doesn't budge. And that was during COVID where we were issuing hundreds of billions in an auction and other times we were issuing a billion. I just look at it, I'm like, isn't it weird we always have a 2.41 cover? And then, every so often China dials back, but Luxembourg and the Caymans step right up. I mean, it's just the whole thing has felt a little stage managed to me in some way. I'm skeptical of it.
Yeah, so I think it's because the banks are the marginal buyer. So why is it Luxembourg? Why is it the Cayman Islands? That's where the banks are. That's where the Eurodollar banks are. So if you're a Eurodollar bank, you're not buying a treasury that's yielding 4% with your money.
Yeah.
You're doing it with someone else's money. And it could be your buddy that owns the bank that's just issuing you dollar denominated credit. So there's no bank reserves, there's no green pieces of paper involved. And so if on your dollar deposits you're paying 1.5%, which is basically what they pay on dollar deposits in the Cayman Islands, and you're looking at a treasury that's just, let's just say, paying 4%, and then the yield creeps up to 4.1, you're like, hit me, because all you're doing is just pocketing the spread. So you don't care what supply is going to do in the next 10 years. You don't even care what inflation is going to do. You could absolutely care less because you're not using your money. Again, it's just basically an arbitrage. So that's why I think the 10-year treasury trades on growth and inflation expectations, which basically, let's just say that's nominal GDP. So if you have nominal GDP expectations at, let's say, 4%, and Besant comes out and dumps just a ton, or $10 trillion or whatever it is of treasuries at the long end on the market, sure, interest rates are going to go up short term, but then those banks are going to have a massive incentive to come in and buy that long end of the curve because they're just pocketing that spread. And if growth and inflation is still at 4%, then the risk reward is a lot better on a 10-year treasury paying 4% when you're using other people's money, as opposed to taking that balance sheet capacity and lending out into the real economy. So that's why I think that you see just such a longer term, there's a lot of noise over the short run, but longer term, why it always trades off of growth and inflation. And it's why if the central banks are selling, you see pickup in London, Hong Kong, Cayman Islands. I don't think it's hedge funds. I think it's the banks.
Yeah, I think so. I kind of wish that we still had M3, which incorporates a lot of those, would have incorporated overseas dollars. We just haven't had that as a measure since 2008.
Yeah.
So,
And I wish it didn't. I wish the monetary system didn't work this way. But as long as the banks are in control of the dollar and the majority of dollars that are created or destroyed, as long as they're in that position, then unfortunately, treasuries are going to be the backbone of the entire monetary system. And the majority of their deposit liabilities are going to be dollar based, and they don't want to take FX risk. So they've got to just buy a dollar asset, and the least risky, especially when the global economy is slowing down, is going to be that it's going to be our debt, which allows the central planners to spend more and more and more and more, which distorts our economy even worse. Chris, and this plays into exactly what we're saying, by the way. So let's just take it full circle here. I did a video the other day on the government spending as a percentage of GDP. And back in the late 1800s, when you include state and local, it was under 10%. So call it maybe 5-6%, something like that. And today, when you include state and local, it's almost 50%. So if people, just a very easy thought experiment is, what if government spending was at 100% of GDP? What would you have? You would have a centrally planned economy. And we know that would be very inefficient. Well, if it's very inefficient, then you're going to have supply shortages. And if you have supply shortages, you're most likely going to have energy supply and resource supply shortages, which would make those prices go up even more. And unfortunately, we may even get to a point where it's so centrally planned, therefore so efficient, that even at the higher prices, we can't come up with the technology to bring those prices back down by increasing the overall supply. And it's another example I use just to illustrate this point is from 1880 to 1900, M2 money supply went up by, right off the top of my head, it was roughly 270%. So 270% during the gold standard, by the way. M2 went up by 270%. But prices during that 20-year time frame went down by 20%. So how is that even possible? Why? Because we were producing so much stuff that we were able to produce, let's say, 300% more goods and services, which on net brought prices down. Where if you fast forward to 2000 to 2020, we increased the money supply by 250%. So 20% less than we did when we were on a gold standard, but prices went up by 50%. Why is that? In my view, it's because you have government as 50% of GDP, therefore way less efficient. And therefore, if we have the same, money supply growth due to the banks or whomever, you're going to have prices go up instead of down, because we just can't produce the amount of stuff, which again takes us full circle into what you're saying. And in fact, it just makes it even worse, because if you don't have the efficiencies to bring those prices down for energy, then those prices will likely trickle through the entire economy and just compound the supply side issues that we have.
Very well said. And being more productive or having more efficiency in your economy obviously can bring prices down. It should, right? That the natural order of things is things should get cheaper over time. All things being equal, because we get better at things. We learn how to make buggy whips faster, better, all that back in the day. But now, George, this chart here, this shows oil production from way back in the day. So this is in the 1904.
Yeah.
Right? So
I'm glad you brought this up, because this is one that I remember well from your presentation.
So, and this is, remember I told you that story, conventional oil, this is awesome. This is, you stick a straw straight in the ground and nothing fancy and oil comes out, right? It's Beverly Hillbillies. Yeah, it's good stuff. So this was the peak in 1970. This included the Gulf as offshore, as this blue stuff here. Alaska hadn't really come on board, but that, we started drilling hard and we came up with Alaska. But you'll see here, that was our peak in 1970. Even when we went to thousands of drill rigs, we managed to get that close, but not quite, by 1985. And it's been downhill ever since. And so people think about the tight oil, which is the red here, shale oil, and say, oh, well, that shows that the peak oil story was wrong. It's like, no, we just found a different source rock. This is what it looks like. This has been amazing. It's not quite the same as this conventional stuff, George. Some of this stuff comes out of the ground. It's like literally gasoline coming out of the ground, really light, You could, some of it you actually literally could out of the Eagle Ford put it straight in a gas tank and it would burn.
Mm.
But it doesn't give you the other stuff. So 30% of what we use oil for has nothing to do with putting it in a gas tank.
Right.
30% is just other stuff.
Yeah, that's what I was
Plastics,
talking about before.
asphalt. Asphalt's the biggie. Like asphalt's this miracle road surface. Like you can brake on it when it's 140 degrees at the surface temperature. It's still grippy at minus 30. It's a really bizarre substance and it's awesome. Very hard to replicate. You can use certain types of concrete, but if we didn't have any oil coming out of the ground, the greenies got their wish. I'd be like, well, what are we making the roads out of? You got to answer that question. I mean, literally what? Bamboo mats? I don't know. Right. So just making a joke there, but the tight oil is not that grade. It's much, much lighter. It has a lot less diesel in it, has a lot less kerosene and jet fuel, and a lot less of the magic tar in there. But if it's hitting a peak right now, using my superior artistry skills, I think it would look like this going forward. So as it goes away, and again, this would be out like 2050-ish. I'm not saying it goes to zero, but George, think about the flow of dollars and all that demand for treasuries and how many offshore treasuries there are. We've had an amazing ability where we actually, on a net basis, dollar basis, we have been net exporters of energy for a while now. And that brings money back into our country. That's about to reverse. This is when the tide has come all the way in. We're at that neap tide, and it's about to go the other direction. It's just going to represent lots of dollars going offshore again. It's going to have huge implications for all kinds of things.
Chris, what's the date on the peak for the red line?
Probably going to be around 20. It's going to be kind of a roundish top here. I expect that's going to be 3-4 years long, and it's between now and 2030. But it's already, because prices are too low right now, George. We're already seeing a big roll off in production. I'll just skip ahead, see if I can find this chart real quick.
Does your projection include prices going up as that supply is going down?
Yeah, no, it's now we're down to geology. Price drove it for up till now.
Yeah.
Now it's geology driving it, right? Because we've gone through what's called the tier 1 rock. There's 6 million holes have been punched in the United States. So the Braille method alone, we kind of know where everything is. And, I'm investor in oil wells. When you find a really hot one and the one before it was slightly less hot and the one before it was slightly less hot, you keep drilling that way into the hotter and hotter zone to get, better oil until you run out. We kind of know where all the sweet spots are. And now they're just infill drilling all of that, right? Exxon's got a big stake in that, Chevron, and, a bunch of mid majors. But the reality is prices have been so low. These are what are called, these are rigs here. And we had 700 rigs here operating in 2022. We're all the way down at last count. This is slightly old charts, a couple of weeks out. It's now at 410. Well, 411 as of last week.
Because they turn them off when the well is depleted?
Because they're not drilling anymore. They're stacking the rigs. And that's one thing. That's the rig. So the rig is what you would imagine. It's a big thing and it makes, drills. And we see the images of those guys working those oily derricks. But once the hole's drilled, now you got to frack it. George, this is what's called a frack spread. This is all the tools and equipment you need to frack a single well. These are giant. If you haven't ever been, you should go and watch one of these operations. These things are like jet engines. These are 700 horsepower diesels here that are trained. They generate ungodly amounts of pressure. You have to have all these frack fluids stored. There's about 1,200 trucks of stuff, water, sand, fluids that come in to support a single frack on a single well.
Right, but notice what you said, diesel. So I think just for the layman, people forget how much energy is needed to actually get energy out of the ground to begin with.
A lot. A lot. If you're standing near these things when they're running, it's like shakes your whole body. It's just astonishing amounts of energy involved in this whole thing. And the frack spreads are down too. So we've lost, since Trump took office, 70 frack spreads. So 70 of those things. Each one of those has, several hundred dudes, usually dudes, working on them.
Right.
So you lose them. They go off. They become bartenders elsewhere or do something different. At any rate, you don't just go to Indeed.com and order up a frack spread crew. It's highly specialized work. and takes a lot of experience. And there's good ones and mediocre ones and bad ones. So I think we're down to the core good ones at this point in time, but even there, we're losing them these days.
So I think the end game here, let's get into that discussion, inevitably is prices going up. Now, will they stay up? Who knows? Because we could have a brand new technology that solves all of our problems. But again, we'd have to have multiple technologies because it's not just, oh, we solved the oil problem. Now we got to solve the copper problem. Now we got to solve the refining problem. Now we've got to solve the uranium enrichment. I mean, we didn't even talk about that, but that's basically like refining oil, if I understand it correctly. And I don't think we do that here yet, do we?
Oh, we have some capabilities there. Yep. And we got some separation plants, but I think
We'd have
we
to
would need a
build
lot
that
more.
out.
Mm-hmm.
Yeah, we'd have to build that out. So let's just assume that at the very least, prices go up, or they have to go up in order for us to get the supply we need. So I think that's, there's no certainties, only probabilities, but that is an extremely high probability over the next, what would you say, 3 years, 5
Yes.
years?
Yep.
Okay.
Barring, the asterisk here is some major recession that really crushes demand. But it would have to be pretty spectacular, I would think.
Yeah, so I think that's definitely a possibility, and I think that's something that we would see, and I think that's maybe something that you're seeing in oil prices right now, because that oil price being at 63 or wherever it is, it's, people just always focus on supply, but they forget about the component of demand. And if a demand outlook is very low, then that could contribute to the relatively low oil price or prices that we've had. So I think the viewer is going to take that under consideration. But even once we get outside the other end of that recession, and by the way, if we do have a recession like that, what's the government's response going to be? It's probably going to be very similar, if not more extreme, than what we saw during COVID in 2020 and 2021. And then, okay, great, now you're juicing the demand side, but what does that do to the supply side? That just takes prices even higher than they were prior to the recession, and that takes you on an even more steep, let's just say, trend line. So I guess, another thing that I'm thinking about with the end game here, Chris, is if those prices go higher and higher and higher, okay, great, that's going to incentivize more supply. If that doesn't happen, then the only other outcome that I can think of is the demand side of the equation has to decrease, which would mean no AI, or that means rolling blackouts or rolling brownouts or World War II, where we're basically rationing. Am I not seeing it correctly? Is there another option?
Well, this gets to the part I've been really worried about. So you see the gray hair, not my first bubble, right? And you remember like 2000, right? Eyeballs, and there was this fiber optic build out, and Cisco. There was going to be no end to lit fiber, and it all ended up being dark for a decade or two till we sort of caught up to that. AI has that same feel to me. The question I can't answer is like, how are we going to make money at this? I see how it's going to take jobs away. I see how it could be actually deflationary, right?
Right.
But like, what's it going to do for us that, and listen, if a million lawyers lose their jobs, I will be the last person to cry, in that scenario. But I, I fail to see how it's going to stimulate something brand new at this point. But that's okay. I'm a show me guy. If it does something amazing, that's great. But all I'm seeing it do currently, George, is take jobs away from people, right? And where NAFTA took away blue collar jobs, AI is going to take white collar jobs, right? And Trump says, well, I'd like to bring the blue collar jobs back, I guess. But guess what's going to happen? Let AI, we're going to build manufacturing again. It's going to be robotic. It's going to be, yeah. Won't take a lot of Rosie the Riveters out there, banging on metal. I don't think, right? Could be wrong, but I don't see it. So the question is, how is AI actually going to deliver these superior returns? So when you're in an energy constrained environment, let's say we have 100 units of energy. We either use these units of energy so we can do normal economic things, right? People take vacations, they feed their dog, they send their kids to school, they do what they do. But if all of a sudden we have to take 20 of those units and we give them to AI, my question is, well, what's the return on that investment? What are we getting back? Like, how is that delivering prosperity to people beyond the data center operators, the chip manufacturers, and the servicers of those pieces of equipment? I can't see it yet, I haven't seen a really good explanation for that yet. I just feel like we're still caught in the eyeballs, phase of this story from 2000. And again, I reserve the right to just be a moron and not be figuring it out, but I've been just keeping a sharp eye out for show me how this makes money.
Right, but the genie's out of the bottle,
It
Chris.
is.
And my point there is, I mean, we can debate the productivity all day long of AI, but if it requires 20 units,
Hmm.
it's most likely going to get 20 units.
Hmm.
People probably aren't even going to be able to connect the dots. Like they'll be like, why is my energy bill 10 times what it was 3 years ago? Why are we having all these rolling blackouts, these brownouts? And very few people are going to be able to say or connect those dots and point to AI and say, hey, because we're taking it in this direction and the government is pushing this for national security reasons or whatever it is. And I think the end game here, to wrap things up, is if we don't get a new technology for each one of these components after the higher prices, there's only one release valve, and that's the standard of living.
Or you have to give up the AI dream and admit you lost the race, but I don't think we'll do that.
Yeah, good point. Good point. So is that a fair summary? I mean, what is, if you had to look out over the next 10 years, what do you think is the most probable outcome?
Most probable outcome is that we have a sudden wake up moment where all of a sudden it's okay to talk about that chart that says we're at peak oil, and that should raise normal planning considerations. We're probably going to see an abrogation of a lot of those LNG contracts. We're probably going to have to see. So, I know him, Mitch Vexler, right? You look at that side, and he's got like $5 trillion of muni bonds. That's like, how do we even pay this back? It's creating this real estate tax issue that's just like going to collapse on itself. I think AI has a similar sort of a vein to it where it's going to cause demand for electricity. And that means derivative, second order things. So demand for electricity is really code speak for demand for natural gas. Great. So natural gas goes up in price. Well, that means fertilizer is more expensive. Plastics are more expensive. Manufacturing processes are more expensive. BASF is moving factories from Germany to here to take advantage of that low cost natural gas. So natural gas becomes less low cost. You saw the CPI. Energy was the big negative in that whole story that offset all the other gains. Prediction is energy becomes a very positive contributor to inflation again. And the problem is, as you know, the Fed can't control that by fiddling with rates. That's a demand issue, demand supply mismatch.
And
So that's what I see coming.
What's ironic about that, Chris, is that likely leads to a disinflation, but not the good type of disinflation. That usually leads to an economic contraction, which goes back to the standard of living. An example I give there is GFC. Did you know when they started cutting rates at the end of 2007, the CPI was right around 3.4%?
I don't
And
remember
by
that.
July of 2008, it was 5.6. And oil, it was because of oil was the main component there, because it went up to 130 or 140 a barrel. So think about that. In July of 2008, oil was, over 100. I don't have a chart in front of me, but it was high. We had the CPI at 5.6%, up 200% since the Fed started cutting. And at that time, the Wall Street Journal was talking about how the Fed needs to reverse and how they need to start hiking rates. And this was July of 2008. And we know how that story ends. And that 2 months later, interest rates were at zero. And we were going through this massive economic crisis, which was the biggest recession since 1930s. And so my point there is not that high oil prices caused the GFC, but they definitely could have been a catalyst, because what happens there is you're having to rob Peter to pay Paul, because you cannot not spend your paycheck on utilities or energy, or else you don't have a roof over your head. You can't provide for your family. So that takes discretionary spending away from other components of the economy, say domestic airfare. And then they have to lay off workers, which increases the unemployment rate. They have zero purchasing power. And then that's what brings the prices down. But the catalyst to those prices coming down is a huge recession or economic contraction. So what you're saying there, if this plays out, I think it goes back to just the release valve being the standard of living.
Well, indeed, and I'm glad you brought up the GFC because it's such an instructive period of time.
Yeah.
And I had a discussion with Luke Groman a while back, and his position was, listen, there's a price of oil that our debt market, saturated as they are. What do we have? $103 trillion of total credit market debt right now in the U.S. There's a price it can't afford, right? Like if oil was 1,000 a barrel, nobody would be able to afford anything. Our debt would crash, right? So there's a price it can't afford, and there's a price below which oil doesn't come out of the ground anymore because it's too low. And the ceiling floors have been coming together for a while. And my
Mm.
prediction is in the next 3 years, the ceiling floor get to a really uncomfortably tight zone. And then we have to start making trade-offs, right? And so if we have bubbles, I think we have lots of bubbles right now. Obviously, in real estate is very unaffordable for vast swath of people, and we've got our AI or our tech bubble, has all the markings of it, most expensive stock market ever, all that. Those are just in search of a pin. Energy prices can't have been a pin in the past, and maybe it wasn't the only cause of the GFC, but oil hitting 147 in July of '08 was definitely a sharp object at that point in
Exactly.
time.
Exactly. So how does someone prepare, Chris? I mean, from a portfolio standpoint, I mean, it's easy to say, look at commodities. I'm not saying buy right now, but you definitely want them on your watch list. What else can people do?
Well, I think just understanding the larger context of this so that you can begin to make certain investments that could pay off. And some of the best ones I know about, George, are in your own homestead. It's because a penny saved is a penny earned, but a kilowatt not spent is going to be very valuable in the future. So today there's still options people can take. There's insulating your home, getting solar, just living in a smaller footprint, if that makes sense, et cetera. There's some things people can do around that. But it absolutely, when it comes to making your plans, I think people need to begin stress testing their future plans against 5%, 6, 7% inflation rather than thinking it's going to go back down to the Fed's long-term target of 2, which I hope we can agree they threw in the towel on that. I think 3 is the new 2. And then 4 will be the new 3. You
Yeah.
know,
But
probably.
the problem is if you do get inflation, low inflation, be careful what you wish for because that means GFC, right? Because that means
Yeah.
economic contraction, that means unemployment rate skyrockets, and yeah, you'll get low inflation then. But
Hmm.
is that better than the alternative? I don't know. If people are looking into a plan B, Chris,
Hmm.
is that something you consider or that you would suggest considering? And what I mean by that is if I'm looking at Panama versus Colombia, would you say, oh, Colombia might be a little bit, forget Petro, the guy that's in charge now, he's a crazed socialist. But assuming that he's not there, would you say, oh, Colombia might be a little bit better bet because they are self sufficient when it comes to energy and maybe Panama isn't? Or what would
Hmm.
you suggest for people looking at a plan B?
Absolutely. So plan B, you're going to have to think through a lot of variables on that. For me, I don't want to have my only option be in the center of some big city because cities are hugely dependent on energy flows.
All
And
right.
they just think when things get tight there, you're around a lot of people who are desperate. And that's not a world I like living in. But right now, looking at what I see in the world, like Argentina is very interesting because they have this enormous shale play that's going to be giving them oil output growth for decades to come, the Vaca
Mhm.
Muerta, the dead cow, right? And Malay seems to have really turned the corner on that whole thing, booted a bunch of socialists out. We'll see if he can make that stick. But they have energy, land, resources. I would be looking at a country that's definitely self-sufficient with respect to energy and food.
That's a good point.
Absolutely.
Yeah,
Yep.
that's I think that's the main takeaway. Just not saying that that's a perfect country, but you definitely got to have Argentina on the list for the plan B. All right, buddy,
Yeah.
how can people find out more about what you do?
My main website is Peak, 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 like Mountain Peak, peakprosperity.com. Chris Martenson on Twitter. Peak Prosperity is a channel over on YouTube. And George, I'd love to have you on my new channel, which it's Peak Financial Investing, because I have a whole secondary business, which is an RIA, which talks about just, well, what do you do financially with all of this? So I got a lot of financial
Any
questions for you.
anytime, buddy, anytime. And maybe we could do a whole show just based on treasuries, interest rates, the debt, the deficits, because that's, I think, very misunderstood and yet absolutely crucial.
Yeah, and anything you could help me understand around how stable coins and treasury demand interplay with each other, because I've been picking at that for a while. Not sure I get it yet.
Okay. Sounds good. Thanks a lot, buddy.
Okay, thank you.